Hello, everyone. This is Sebastian McMahon from IA Financial Group. I'm back with another weekly edition of the Economic Review. So this time for the week ending April 29, 2022. So let's start with a look at the markets. So we had lower interest rates on the week, meaning positive gains for bonds. As I am recording this on Friday morning, markets are about to open. They're about to open in the red. So some of these trends are reverting here for bonds and also for the stock market. So that the S&P 500 was positive on the week, but it's about to open down about 1%. So we'll see where we end up after that, but outperforming Canada, emerging markets and EFI. And then you have the price of oil, which was up on the week. Canadian dollar was negative after 4 days, but today it's looking pretty strong. We had a very strong print on GDP, twice what was expected by the Bank of Canada only 2 weeks ago for Q1. They were expecting 3%, and it's looking like we'll have close to 6% growth in Q1. So very, very strong, and also pushing for, or at least supporting the view that the Bank of Canada should be hiking very strongly, quickly, with 50 basis point hikes a few more times this year, and the price of gold suffering from a strong US dollar. So I want to dig very deep into the topic of what's going on in the bond market and the negative returns. I've had many questions on that, so I'll do that. Before we dig into that, just one topic, US GDP. So as you can see on your screen, we had the US GDP print coming out yesterday on Thursday. It was negative, mostly because of the foreign components. So exports were lacking and imports were very, very strong. So this is a detractor to GDP. Also inventory drawdown, which was a detractor to GDP, and we're getting less support from the government. If you take away these parts and you look at consumption and business investment, it's actually going even better than it was in Q4. So there's no catastrophe in this one, but it goes to show how we can have like a technical recession over the next few quarters, having 2 consecutive quarters in negative territory for reasons that won't lead to a spike in unemployment and a loss of revenues for everyone. We could easily see that in the next quarters, and it just reminds us how fragile the economic picture remains. So no big problems here, but still markets are looking at the odds of a recession, and an accident along the road could be easily seen with all of the moving pieces that we have right now. So digging into bond returns. So this chart here, the drawdowns since 2006 on the FTSE Canada Universe Bond Index. So whenever you buy a bond fund, odds are very high that its benchmark will be this index right here. So this is the broad index of bond performance in Canada. So I brought it from 2006 here. So that's because that's the data that I have available for daily data. And this is a drawdown. So how much of a pullback we have from previous peaks. And as you can see, since 2006, we've never seen anything even close to that. We're down 12.5% from the prior peak, which was in March of 2020. Other indices, broader indices, but have less granularity, so I didn't bring them here, showed that you have to go all the way back to the 1970s or early 1980s, depending on the region or the type of product, to have such a strong drawdown. So it's an historical thing that we're seeing now, how badly hurt the bond market has been. So it's completely normal that you have questions, that you want to understand what's going on, and you wonder, well, do I need bonds in my portfolio at all? So the answer remains always yes, because of diversification properties. And I'll explain why the rates went high as quickly. So the market rates, and why we think that, I mean, you never know where the peak is, but I mean, probably most of the damage is done, and we're starting to look at good opportunities to buy into bonds. So if I start with the decomposition of the rise in rates year to date. So since the beginning of the year, you have the change in 10-year rates in Canada, US, Germany, UK, and Japan. So let's focus on Canada and on the US here. So if you look at Canada and the US, in both cases, since the beginning of 2022, rates are up by about 1.3, 1.4%, close to 1.5 for both regions. So that's the red dot. So rates are higher everywhere. But when in the market you have real return bonds, so bonds that are linked, the returns are linked to inflation, so you're protected for the changes in inflation, and you have traditional government bonds. When you look at the rates on both, you can infer about the expectations for inflation by market players. So that's the gray part of these charts here. So the inflation component says that over the next 10 years, okay, since the beginning of the year, investors have changed their mind that inflation is going to be higher by about 0.4%. So that's the gray part of the chart. It's true for Canada, pretty much true for the US too. The blue part is the real rates, so it's a mix of many things, expecting the views on economic growth for the next 10 years. But here it's more about the expectations for the views for how the leading rate will change from central banks. So market rates are determined by you and me when we buy and we sell bonds. So that's the price of the bonds. But the leading rate is decided by central banks, and it's the overnight rate, meaning that it's the rate at which financial institutions have to lend money to one another overnight and clearing on the following day. So that's the leading rate. And if you want to learn more, Economy and Finance 101, I did a video on central banks, their roles, what they do. There's also another one on how interest rates impact the price of a bond. So there's material there. So ia.ca/economy. And then you click on Economy and Finance 101. There's material there. So you can pause, go there, come back if you want to. So the blue part is the main part here, and it means that the 10-year rate since the beginning of 2022 went up by about 1% on the back of expectations for tighter monetary policy, and another 0.4%, something like that, about expectations for higher inflation over the next 10 years. So that's a decomposition. So moving to the next chart here, another market indicator about how much tightening from central banks is expected can be inferred right here from market data. And if you focus on the, this is a huge spaghetti, I completely understand that, but the blue line on top, you see that there's about 8 hikes of 25 basis points that are priced in the market expected by the end of 2022. So that's 2% more hikes on the leading rate. This is for the Bank of Canada here, pretty similar in the US. So the market has already priced most of that for the market rates, the rates that are important for the returns in your portfolios. So the drawdown from the FTSE Canada Bond Index that I showed a few minutes ago, the damage is mostly done already because the market expecting hikes, rates went up, and you already have the negative returns in your portfolio. So the question I was asking, that's why I'm bringing here side-by-side charts of the leading rate versus the 5-year rate. You see, the leading rate just started moving, so it went from 0.25 to 1, and it should go all the way to 3%. The question I got asked this week was, well, if we're already 10%, 12% down in a bond portfolio, and we only got started in the moving of the leading rate, does that mean that I'm going to be ending up with a -40, -50% by the end of the year? The answer is no, because as you can see here, I brought the 5-year rate because I want to show you how the many rates that are out there. But here, the 5-year rate is more reactive to the expectations on central bank. As you can see, the moves from the Bank of Canada that are expected by the end of the year are largely reflected already in market rates. So no, you're not looking at a lot more pain. I mean, just doing the rule of thumb that, well, we moved 75 basis points, 2 more, so I should be down 50%. That's not how it works. We're looking at maybe topish now, market rates. We don't know exactly where the top is, but we know that we're getting closer to it. And even if you're right now, you start investing in bonds, you'll be getting interest rate coupons that are much higher than if you bought in 2021 or 2020. So the bond market is making much more sense in a portfolio now for future returns and for diversification purposes. I mean, it hurts when the market is not going your way, but going forward, it's not the time to remove bonds because there's probably more brighter prospects going from now. Although I can't guarantee returns, of course, we never know how the markets behave, but in our funds, we are in the process of buying more bonds right now to close the underweight gap and to benefit from higher rates. So that's what I wanted to clear. So again, Economy and Finance 101, there's some material, and if you have feedback, you can always send it my way, and make sure that everyone's comfortable with everything that's going on here, because it's clearly historic. So if you have questions about that, those are good questions, because it's not every year that you see something like that. So what to watch next week in Canada? We'll have the jobs report, should be pretty good. We have some strong momentum here with GDP, should carry on to April, so expecting some good figures here. And in the US, we'll have the services index from ISM, the manufacturing index from ISM. We'll have the decision by the Fed, so 50 basis points is expected next Wednesday afternoon, 2 p.m. Eastern. That's when the decision should fall. Mr. Powell will be speaking at 2:30 Eastern, so it's always a good idea to listen. And after that, we'll have the jobs report. About 400,000 jobs are expected, so it should be good. So ia.ca/economy, your go-to webpage. Economy and Finance 101, very useful in these times, and you can follow me on Twitter and on LinkedIn. Always a pleasure, and I'll be back again next week.